I'm very pleased to introduce the first panel, which really sets up the main theme of the conference, the macroeconomics of decarbonization. And we are fortunate to have a moderator, Glenn Rudebusch, who is a distinguished academic and Federal Reserve economist. He's spent many years writing papers about macroeconomics and has been at the San Francisco Fed. He has started the virtual seminar in climate economics a couple of years ago, which has been a great forum for research on climate change. And he has now joined us as a visiting research professor at the Volatility and Risk Institute at NYU. And we're very happy to welcome him and have him introduce his panel this morning.
Thanks, Rob and Dick. It's a great conference you've put together, and welcome to everyone for this first session on the macroeconomics of decarbonization. I'm at NYU and Brookings Institution, and it's a pleasure to moderate this first session. We will have two presentations followed by a discussant and then a Q&A session that'll include questions from the broad audience on Zoom. Our first presentation is by Jean Pisani-Ferry. Jean Pisani-Ferry is professor of economics with Sciences Po Paris and the European University Institute. He's a senior fellow at Bruegel, which is the European think tank of note, a non-resident senior fellow at the Peterson Institute, and he leads the CEPR Research and Policy Network on the European economic architecture. His publications include numerous books and articles on economic policy and European policy issues. He's also been an active contributor to public debates with regular columns in the international media. John, please start.
Thank you, Glenn. And let me start by sharing my screen. I guess you should be seeing my screen.
Yes.
I'm very happy to follow up on what we heard from Senator Whitehouse, because I think it's a fundamental debate. The assessment of the consequences of climate action and the way this debate is developing. I wrote for the Peterson Institute, and I think that's the reason why I'm invited today. I wrote a piece last summer discussing the fact that climate action is bound to have deeper, larger macroeconomic consequences than frequently assessed in existing simulations. And in a way, I sort of, triggered a discussion, not because of the virtue of my paper, but just because the issue was there. And I think that was the moment when people wanted really to start having this discussion. So, sorry. Yeah. The issue, in my view, is that the macro dimension of climate action has for long been relatively neglected because of a combination of the intellectual origins of the discussion on climate and because of the horizon. Basically, 1 or 2 years ago, most international institutions, treasuries, etc., remain at a distance from the issue. I mean, the issue was seen as an important issue for the long term, but not something that was really of major relevance for the horizon at which these institutions work, namely the horizon of, let's say, next 3-5 years. And there is now a growing realization that, in fact, it's not the case, and that climate policy, in a way, is macroeconomic policy. That's actually the title of a recent paper by Marconi, saying climate policy is macro policy, and I think that's absolutely right, and that's exactly what I wanted to sort of point out in my own paper. By macro, I mean growth, I mean inflation, I mean labor markets, I mean public finance, and I could go on. Isabel Schnabel of the ECB has also been vocal, emphasizing that climate action is both important but also consequential. In her case, especially on inflation, and she's been focusing on greenflation and its consequences for monetary policy. So what I want to do today is sort of discuss why it is the case, sort of outline how I would approach the issue, discuss a bit the methodology, and conclude with some further issue and some policy conclusions. So first, why climate action has become a macro topic. As I said, it's a matter of horizon. It's also a matter of acceleration of action that is taking place, especially in Europe. I mean, in Europe, we've really changed in terms of the policy horizon. Not enough, actually, but the goals set by the EU of carbon neutrality by 2050 go together with a very ambitious target for 2030 that's really much closer to the policy horizon. There also has been an increase in the price of carbon on the market for carbon quotas, and they are increasingly a series of regulations. A good example being the fact that combustion engine cars are by now supposed to be banned from sale in 2035. So the transition risks have become much more significant. I'm not going to speak about physical risk, only transition risk. And so it's becoming part of the macro landscape. Just to illustrate what I'm saying, these are the emissions in the EU. So until 2019, we had a 25% reduction in emission in 30 years. Now we're planning a 40% reduction of emissions in 10 years. So this is a significant acceleration, a very significant acceleration. On the right, you have the price of carbon on the ETS market. And again, until 2019, there was not much movement on this market. There had been difficulties with the consequences of the global financial crisis and the oversupply of permits that resulted from the allocation mechanism. This was gradually solved, and now we have a much higher price on the carbon market. As regards the long term, and I think I want to emphasize that because I don't want to, the confusion with the pessimistic view on the non-feasibility of the climate transition. There is growing optimism as regards the long term. I think almost everything we've learned over the last 10 or 15 years gives us reason to be more optimistic about the fact that we're experiencing a technology revolution that goes faster and is deeper than expected some years ago. I'm just quoting here a paper by Philippe Aghion or two papers by one with Taran Acemoglu and one also a policy paper that he wrote for me when I was at Bruegel, basically saying that endogenous technical progress is really the way to look at these issues. And then when we look at these issues through these lenses, they're very strong reason to be much more positive. I mean, even perhaps he would go as far as saying, these people would go as far as saying that, fossil fuels distracted our economies from the right path, from the efficient path, because of an addiction to technologies that are not the most efficient ones. There are some exceptions. Food is clearly one. I mean, there is no technology that makes it possible to produce meat without emitting. But for the vast majority of our emission, this is the case. Now, there is uncertainty about the transition. And I think there has been an abuse of the optimistic view in policy discussions, with, for example, President von der Leyen saying that the European Green Deal is a growth strategy, and you've had the same in the US, with President Biden telling the American people that climate change is about jobs. Yes, it is about jobs, but it's also about the destruction of jobs as well as the creation of jobs. I mean, we can't look at it without actually, pointing out that there are transition costs. And central bankers, I think, have been relatively good at that, with the network for greening the financial system, emphasizing the risk of transition cost, especially in the case of disorderly transition. One way to sort of, have a sort of snapshot at what it may imply is to consider that the rise in the price of carbon or an equivalent regulatory tightening amount to a negative supply shock. That's basically putting a price on a resource that was available for free, climate, and we know that putting a price on a resource that was available for free or increasing the price of a resource has a supply side effect. We have had experience with it with the oil shocks. We're actually, going through another experience of this thought with the consequences of the war. And the increase in the price of carbon is, well, we're having all this discussion on what's the right price for carbon. But the world price of carbon is probably at maximum $10 per ton. I think it's probably much less, but there are different ways of measuring it. The target price of carbon for 2030 is, if I take the Stiglitz-Stern recommendation, it's $75 per ton, and it's easy to find many estimates that go beyond. The NJFS with more than double this price level, and a number of estimates of the Shadow price that go much beyond. So if I take the Stiglitz estimate and I multiply it by the level of emission, I'm coming up with a price tag of 3.1% of world GDP. So 2.7% above the status quo. And this is major. This is the equivalent of this is exactly equivalent to the oil shock we're suffering in Europe at present. It's commensurate to the first oil shock. So it's not a trivial change. And I think we should be considering the implication. Now, this is not uniform. So if you look at the situation of different type of countries, ranked by GDP per capita, it's going to hurt especially emerging countries. Advanced countries have become less reliant on fossil fuels in terms of the less reliant on energy. I mean, the energy intensity of their GDP has decreased. Poor countries are also less energy intensive. Sort of middle income emerging countries are especially energy dependent. So the emerging markets are going to be hurt, especially if, or would be hurt if this price were to be applied. It's the reasons to also have a sort of more benign assessment for advanced countries. Obviously, when I do the comparison with the oil shock was a transfer to the rest of the world, to the oil-producing countries, not for the US, but at least for Europe. This is not the case with the pricing of carbon. Also, there has been some learning on how to deal with oil shock, and the oil shock of the 2000 had less of an impact than the oil shock of the 70s. But all that being said, this remains a significant change. Now, my second point is, how should we look at the way it affects our economies. So I'm a sort of a bit concerned that the fact that for obvious reason, for the necessity of having a dialogue with the engineers, of representing the detail of the energy system, of taking into account the sectoral dimension of the problem, there has been a tendency to rely on very detailed model. And the problem with very detailed model is that at some point you lose, you're losing the forest. You don't see the whole of the problem. You're focusing on certain part, and you're having difficulties finding out what we're talking about. I would say, fundamentally, the transition is about two things. One, which I'm not going to speak much about, is the question of the change in consumption patterns away from carbon-intensive goods towards less carbon-intensive goods, so change in individual behavior. The other one is about substituting capital to fossil fuels. So we have, if you write a sort of a production function, you have energy that's produced with capital and fossil fuels. I could add renewables, but renewables being free, wind and solar, that's basically capital that you have to put to produce electricity or energy. And what you want to do here is to get rid of the fossil fuels, to substitute away fossil fuels with capital. And then for the aggregate production function, essentially you're also using secondary energy, but you're using fossil fuels. And again, you want to substitute away fossil fuels with electricity. So it's basically a capital substitution effect that is at work here. So it's a capital-intensive transformation. And this capital-intensive transformation is very visible if you look in detail at the changes in final energy consumption and electricity consumption that is in the card in the scenarios actually produced by different policy institutions here in Europe. In all cases, you have a change in the electricity consumption, that can be doubling or more. And you have a change in the final energy consumption, that's a reduction in the energy intensity of GDP. So it's basically this process I was describing. And what this process requires is significant investment. So there is a degree of empirical convergence on how much it will require. I took here a series of scenarios that are produced independently by the International Energy Agency, by the European Commission, by the Climate Change Commission in the UK, by the RTE, the utility in France, on what it requires to get to carbon neutrality in terms of the investment, the additional investment in 2030. 2030 being, the horizon at which you can actually do some programming and that influences the outlook for the years ahead. And essentially, there is a convergence around the view that by 2030, we will need to have some 2% of GDP more investment than what we would be seeing without this transition. Here, you have a representation of what this entails, and this is taken from the report of the UK's Climate Change Commission, which is, in my view, very, very clear and transparent on what it implies. Above the line, you have the additional capital investment. So basically, this 50, it's in billion of pounds. This 50 threshold represent about 2% of GDP in the UK. So it's consistent with the numbers I was mentioning. And below the line, you have the savings on operating costs that's generated by this investment. So essentially, you have to invest upfront to reduce the cost, in the future. Now, what it gives, if you sort of do a very simple calculation, which is to look at the cumulative investment net of operating cost reduction in the UK along this pathway leading to net zero, you see that up until 2035, you have an increase that reaches 15% of GDP, and then it decreases as the effect of this investment on operating costs shows up. The annualized resource cost in terms of NPV is given here. It's 0.6 to 1% of GDP. And so that's basically the description of what's going on in such scenarios. So this optimal scenario, and I'm saying it's optimal because it doesn't include any premature obsolescence of the existing capital stock. The assumption behind is that you're replacing capital when it comes to the end of its economic life. So there are no additional costs related to sort of disorderly transition. So this corresponds to a gross additional investment total of 50% of GDP. And as I said, to an NPV net of operating cost of 15% of GDP. So it's not negligible, but if you compare this cost to other costs we have incurred, for example, you compare with the cost of aging, or you compare to the cost of the global financial crisis, it is perfectly affordable. But it's not something you can neglect. Now, what do models, what do simulations say about that? What is striking is that when you look at simulation, you essentially find some messages. It's a small and positive effect. So this is taken from the NGFS simulations. So the green part is the physical risks. The gray part is the transition risk. And by 2030, you see the message is it's slightly positive if you do it now, if you invest now. If you delay the transition, it's become negative because it's going to lead to an accelerated obsolescence of the existing capital stock. So basically, you're going to waste much more capital. But the view here is that there is no cost basically if you do it now. There might be some in even 2030 it's positive. So basically it's a gross positive. And I think I'm a bit puzzled by these findings because I wonder why is the impact of substituting capital to a free resource something that's gross positive. If there is on top of that some obsolescence of the capital stock, it should be more. If there is on top of that some shifting away of low carbon intensity, from high carbon intensity to low carbon intensity goods, it's going to be more. And so I wonder why it is so small. Now, just to criticize some model builders who are not here, I looked, for example, at I give praise to the CCC for the work done on assessing the cost. Now, on the macro side, what they've done is just nonsense. I mean, basically considering that the additional investment is a Keynesian boost, that they're going to be a gain from mobilizing spare capacity, and that they're going to be a gain from substituting domestic resources to imported resources, but they're not going to be any loss from having less export revenues because it is assumed that no parallel action is taking place in the rest of the world. I think we ought to be much more careful about the assumption that lead to this kind of relatively rosy scenarios. My time is up, so basically what I would wish to conclude is first in terms of methodology that we sort of need to be, again, there are good reasons why we're relying on simulation with large-scale models, but we've got to be more careful on understanding why we are getting the results we're getting. Clearly, the assumption that there is spare capacity in the economy and that the climate transition is just an opportunity to have more investment, therefore more jobs and more growth. First, it's not true in the situation of some economies like the US economy very clearly at present. Second, that's not the kind of assumption you're making when you're evaluating a medium-term policy in general. So I think that should not be the basis for the analysis. But second, we need a sort of much better tractability of the reason why we are getting the results we're getting. Let me skip all that. So I sort of would like to conclude on the fact that there is an analytical challenge that we are confronted to. That's to come up with proper methodologies and have a serious discussion about the consequences of climate action. I'm focusing here on GDP, but you could say the same on inflation. Second, on the policy agenda, there are also consequences in terms of defining what are the key variables and what should be the key action program for minimizing cost and for setting guidelines also for public finances. I think that's major. Increasingly, I see this discussion starting again, which is good news. I think we are far from having solved all the problems that are raised in this kind of discussion, but I think that's a useful discussion we need to continue to have. Thank you.
Thank you, Jean. That was a great presentation. I agree that macroeconomics has been slow to grapple with climate change, and it's going to make huge differences. Just like international and micro and public finance is a whole set of important issues that still need to be worked out. Our second presentation, we'll go right to our second presentation, and then we'll have, again, save questions and answers in the Q&A feature for the end. Our second presentation is by Warwick McKibbin. Warwick is a distinguished professor of economics and public policy at the Australian National University. He's also a non-resident senior fellow at the Brookings Institution. Warwick is internationally renowned for his contributions to global economic modeling, the theory of monetary policy, climate change policy, and the economic modeling of pandemics. He's published over 240 peer-reviewed academic papers and has served on the policy board for the Australian Central Bank. Thank you, Warwick, for attending.
Thanks very much, Glenn, and thank you to the organisers for inviting me to come. I think my presentation follows quite naturally from Jean's presentation. I'm taking a totally different approach to Jean, but I think I agree with much of what he said. Let me just share my screen. I'll just make sure that people can see that. Glenn, can you see my screen?
Yes.
Okay, so what I want to talk about today is climate change and monetary policy, issues for policy design and modelling. The presentation is based on two papers, one in 2020, which looked at climate change and monetary policy issues for policy design and modelling, which has been published in the Oxford Review of Economic Policy. And the second was the Sintra Forum lecture that I gave at the end of last year, which was a joint paper with Maximilian Condat and Beatrice Huerta de Moro. We've actually been working on the macroeconomics of climate change for 31 years, it turns out. But the sort of approach we're taking doesn't fit naturally into the small macro journals that have a very narrow view of what is macroeconomics. So what I want to talk about then is basically cover a little bit of the ground that Jean covered, but basically outline the climate basics and monetary policy basics, why the interaction of monetary, climate, and actually fiscal policy as well is really important. And I'll produce one example from some of the modeling that we did for the Sintra Forum. And so in thinking about climate change, climate change is both important for macro because of physical risk, shocks to the economy that come through and change productivity, change economic outcomes, but also transition risk, which are the responses of policymakers, whether it's carbon tax policy, infrastructure policy, or how central banks respond. And so there is a big macroeconomic issue here that we have known about actually for a very long time. There is actually a large literature. You can look at the Energy Modelling Forum out of Stanford and a whole range of different modelling groups that have been looking at this issue for a very long time. The key point for monetary policy is that this is unlike many other macro shocks, is we have both aggregate effects, and as Jean points out, there'll be shifts in aggregate investment, shifts in GDP, but there's also very sector-specific effects. So when you change the price of carbon or when you have a carbon shock, it changes sectoral output, and very importantly, it changes relative prices. And the relative prices changing will have aggregate inflation implications. And so there is an important role here about the sectoral composition of any given economy. It's also true when you're looking at climate policies. So different climate policies have very different effects on inflation and output at the aggregate level and at the sectoral level. When you put in carbon pricing, I'll talk about it shortly, you change price trends, you change price volatility, you change potential output, and you have aggregate demand effects. So it is quite a complex set of issues, and Jean has touched upon these, but I think you need to go further. So what are the type of climate policies people look at? And mostly in the pricing space, and there's many different ways you can deal with climate change, but economists focus generally on pricing. A permit trading system is where you fix the amount of emissions in the economy. The market will trade where people who need emission permits because their costs are higher than, the cost of abatement is higher than the cost of buying a permit, will buy and sell in a market, and the price will be determined by the market. So the price that comes out of this is a volatile price. A carbon tax is a system where you set the price per unit of carbon in a particular energy source, and then the market determined outcome is the amount of emission abatement that's done in different parts of the economy. So in this case, the carbon price is fixed and predictable. This is very important for central banks. You can also create a hybrid, which work with Peter Wilcoxon and I have done over many years and was published in the Journal of Economic Perspectives, combines the short-term carbon price being fixed with a long-term market-determined carbon price, very similar to the monetary policy framework where central banks set the short-term interest rate, but the bond market sets the long-term bond price. And you can map that into a carbon central bank and a carbon bond market. So you can actually get the advantages of the permit trading, which is setting the long-term price in a market, but get the advantages of price predictability by having a central bank of carbon set the price in the short term. And of course, the alternative approach, which is most often adopted, is regulatory approaches, and the carbon price is very hard to work out, but there is a carbon price. So that's sort of climate policy 101. Monetary policy, there's a large literature on monetary policy. We know from that literature that rules are better than discretion. We also know from that literature that the best rule is not predetermined. There is no single best rule. The nature of the shocks really matter for whether you want to use different types of monetary policies. And it is an important question. Right now, if the world is looking to be carbon constrained and climate disrupted, are the traditional choices of inflation targeting the best rule for central banks to follow? And what we know from the literature going way back to Mead and various other authors back to the 50s is that most monetary rules handle demand shocks well. But managing supply shocks is complicated because it involves trade-offs between inflation and output stability. Once you start looking at supply shocks, some rules are better than others. And the way to think about climate change and climate shocks and climate policy is a world of much greater supply shocks, but also there will be demand shocks. So what are the monetary rules that we see historically? There's inflation targeting, price level targeting, the Henderson-McKibbin-Taylor multi-factor type trade-offs between inflation, output, and other variables, and nominal income growth targeting. What's important in these rules is they use different information and they're relying on different types of forecasts. So one of the key issues we've raised in the literature for a number of years is that once you have these rules compare, when you have a climate constrained, climate disrupted world. And I'll draw that out a little bit. One of the key problems you have is the importance of the output gap in an inflation targeting central banking world. Most central banks, when they're forecasting inflation, they're forecasting the output gap, and that provides them with a forecast for inflation. Output gap estimation becomes really important in all of these rules, except really in nominal income growth targeting. Once the output gap, when you look at the data over the last 20 years, the forecast of the estimation of output gaps has deteriorated. And Augustus Panton, a PhD student of mine that's now at the IMF, did his PhD looking at whether you needed to adjust these output gaps for climate variables. And he finds an important role for climate variables in output gap estimation. So what you'd expect to happen if you don't adjust your current framework is your capacity to forecast the output gap will deteriorate. The capacity for central banks to then do forecasts of inflation will deteriorate. They'll get the inflation forecast wrong, and they'll undermine their credibility because the framework is being undermined by the nature of the shocks. So from an inflation point of view, from a central bank's point of view, all of the optimal policies that people have looked at involve an increasing price of carbon. So it's not just that you have a carbon price today of say $50 a tonne. The optimal policy is to have a carbon price that rises at the rate of interest. This is what's called a hoteling rule. So you're going to introduce a new trend in inflation rather than just having a volatility in inflation. You're going to have volatility and a trend change, and that's important for central banks. It is also, as I mentioned, carbon price volatility will be higher under cap and trade than under a carbon tax or a hybrid system. So central banks would prefer the carbon policy regime to be a carbon price, fixed price in the short-term type regime rather than a flexible regime. So the bottom line for monetary policy is that monetary policy makers will face more frequent large and negative supply shocks. When you think about what central banks do in an inflation targeting environment, if there's a shock which reduces output and raises inflation, an inflation targeting central bank would tighten monetary policy and cause a worse output outcome, unless they can look through it. And this is a problem because if the shocks are continuously supply shocks, central banks will have to say, we're adjusting our monetary framework because we have this particular shock which doesn't fit naturally into a flexible inflation targeting regime. And sometimes you can't actually identify the supply shock. And so therefore, inflation targeting or flexible inflation targeting is not going to work well in a climate disrupted world. Price level targeting is even worse because not only do you eliminate the inflation rate shock coming out of the climate shock, but you actually try and get the price level back to where it was. And that's going to cause much more output loss. And so really under each of these standard inflation type targeting rules, the central banks have a problem. It turns out that the HMT type rules balance output and inflation effects, but you still need in those rules forecast the potential output and output gaps. And we argue that in fact, the breakdown of these because of climate shocks and climate policy will really undermine the credibility. The one monetary regime that seems to work quite well in the work we've done, and actually in the historical work going all the way back to Mead, is nominal income targeting, where you don't explicitly, you have an implicit output growth target and you have an explicit inflation rate target. You combine the two together to get a nominal income growth target, and the central bank targets the nominal variable. And then whether you have higher or lower inflation or the higher and lower output than you had actually targeted, you still maintain credibility if you can hit your nominal target. And we've shown elsewhere that you can anchor inflation expectations in a nominal growth world as well as you can in an inflation world. So what does this mean for policy models? It means that you're going to need a lot more sectoral disaggregation. You can't take a 3-equation New Keynesian model and do serious climate policy with that. One of the problems we're seeing in many central banks is that that's what they're trying to do. What you need is you need to capture the relative price impacts, you need to capture the sectoral output changes, and you need to model how they impact on the overall inflation process. So that means you need a lot of energy detail in your model, and you need a global model because of the cross-country flows of goods and services through production chains and cross-country energy flows. So the idea that you can use a current standard macro model to do climate policy, I think is problematic, and it will lead to the sort of results that Jean has pointed from some of the models he talked about. Let me just finish by giving you one example. And what you can learn from a model which has a lot of trees, but you still can understand both the forest and the trees. This is from a paper, as I mentioned, from Max Krondart and Beatrice Huerta de Moro. Now, there's a lot in this paper. One of the things we did was looked at whether historically climate policies had caused higher inflation or lower inflation in Euro economies. And we found very little impact on inflation. The model we're using is a G-cube model. This has been around for a long time. It's actually documented in the Handbook of CGE modeling. It's a joint model with my co-author, Peter Wilcoxon. And it's a hybrid of DSG type models that we see in central banks and CGE models, which have a lot of sectoral detail. It captures industry flows of goods and services, international trade, international capital flows, and it has an intertemporal model of consumption and investment. And investment is determined at the sectoral level. It's annual. It's very, very different to an integrated assessment model. It has an annual time step, and it focuses on short-term macroeconomic dynamics within an internally consistent long-run growth model. There's a lot of frictions. You have unemployment in the short term, full employment in the long run, and you have, very importantly, quadratic adjustment costs to capital accumulation. This is really key to understanding why it can be expensive to undertake climate policy and how to smooth out those economic costs coming from the movement from capital, as Jean mentioned. Moving capital from one sector to another is not costless. The model we've used and we've been using is in the World Economic Outlook from the IMF several years ago. It's been used widely for energy and climate issues and macro issues in certain institutions. 10 regions for the world, 5 advanced economies, 5 emerging regions and countries. You need to model the complexity of the world because the endowment of fossil fuels, the level of economic growth, the rate of economic the level of economic development, the rate of economic growth, the demographic profiles going forward, all drive the adjustment of emissions over time and economic growth over time. This is very different to integrated assessment models, which tend to take GDP as given. In this type of model, GDP is the outcome of a process of decisions of firms, households, and governments. Now, there's a lot of detail in this model. We have 20 sectors in each of those 10 regions. We have a lot of electricity generation details, because when you change the price of carbon, you change not just fossil fuel versus non-fossil fuel, but you change the relative attractiveness of gas versus oil versus coal versus wind versus solar. And we have a lot of disaggregation within the economy because with the relative prices changing in the energy sector, but because different sectors use different mixes of energy, capital, labor, and materials, you will change relative prices throughout the economy. And so you need to capture this relative price shift because that changes the substitution decisions of firms in production and households in consumption. So this is modeling the macroeconomy from the bottom up. Now, just to give you the one example, because I know we're a bit short of time, the way we run this model, we run the model from 2019 to 2100. A lot of assumptions have to be built in. Population growth by country, productivity growth by sector by country. So we have a Barrow catch-up model at the sectoral level. We have to make assumptions about technologies at different points in time. And very importantly, we need very clear fiscal rules and monetary rules, because the policymakers' reactions to the climate projections and the climate shocks and the climate policies actually matter. And so you can't really determine the impact of a particular climate policy until you know how the central bank will respond, until you know how the fiscal authority will respond. Will they take the revenue from a carbon tax and recycle it in a particular way? So it's very important that you do this in a general equilibrium framework. So the shocks we're talking about, we're running the model all of a sudden in 2021, people realize there's climate shocks. In 2021, people realize there's going to be a climate agreement. And not everybody understands this fully because 30% of firms and households have rational expectations. So they use the model to forecast the future effects in different sectors and in their human wealth and their financial wealth. But 70% are following a rule of thumb. So it's an optimal rule of thumb in the steady state, but in the short term, they don't update their information every single year. Now, I won't go through this except to say that we looked at 2 different monetary rules in the ECB Sintra Forum paper. The first one is the Hartmann-Smets rule, which is published in the Brookings papers on economic activity, where they say the ECB changes the interest rate based on a coefficient they estimate on the gap between expected inflation and expected target inflation, and a coefficient on expected growth relative to target. And we modified that because there's a lot of forward-lookingness in that rule, and we modified it so instead of the pure Hartmann-Smets, we put half a weight on the current information set and half the weight on the future information set. Any aficionados of monetary theory won't recognize this. People who aren't that involved in that literature probably wonder what that is. But anyway, let me just say, the idea here was to take those monetary rules, two different monetary rules, hit the model with different shocks. So the shocks, and I won't go through all of this, obviously. We have another paper where we look at global climate risk. And in that model, we show how to model chronic climate change events and extreme climate events, and how you can feed them through to create productivity shocks to look at the economic consequences of climate change. And we are using what we call the representative concentration pathway, which is a pathway for emissions with a particular temperature outcome by 2100. We feed that through and we calculate how to do the shocks to the model. So they're the climate shocks, which I won't do, but I just wanted to mention that you can do that, and we do that. And it's not that nobody's ever done that, but it's that a lot of people don't realize that that work has been done. What the exercise here is very simple. We're going to put a carbon tax in the Euro countries at $50 a tonne in 2021, rising by 3% a year, approximately the real interest rate in a normal world. So the two things I want to stress, and I'll be finishing here, is firstly, these are the impacts on the left. This is the deviation from what otherwise would have been the case of energy prices in the economy in Europe. And you can see that this blue line is the increase in coal prices. So the price of coal goes up a lot. It has a lot of carbon intensity. The price of gas goes up, not as much because the carbon intensity is a lot less. And you can see that all the energy prices tend to rise. If you look on the right, these are the non-energy sectors. And you can see that in some sectors, for example, transportation goes up by more because it uses a lot of energy as an input. But interestingly, and this is where this model is quite powerful, there's one price that goes down relative to the others, and that's the European construction price. This is the price of construction in Europe. The reason is because in this model, when you announce the credible policy, the investment in the fossil fuel sector drops. The investment in the renewable sector doesn't expand quickly enough because of quadratic adjustment costs. That's without any government intervention. You can change that with a government intervention, but just purely from a market pricing mechanism. And so the demand for investment goods falls, and the demand for investment goods, one of the key inputs is construction. And so the fact is that the sectors that are getting impacted in the second phase have a very different relative price effect than the primary energy sectors. And so all these things matter for the macroeconomic outcome. What is the macroeconomic outcome? This is the final screen. On the right, notice that under the modified Hartman-Smets rule, inflation goes up in the first year because the price of inputs goes up. But under the Hartman-Smets rule, inflation actually drops. Inflation drops because under Hartman-Smets, the central bank contracts the economy a lot as a result of the policy, where they're looking at what's happening to growth in the future, and they see this drop and then recovery. So they tighten monetary policy, and it's deflationary. So the outcome for inflation depends on the monetary policy reaction function of the central bank. There is no rule of thumb that it's always going to be inflationary. A sensible reaction function would probably lead to a trade-off between take the inflation hit at the beginning, but allow the fact that you know that now potential output will be lower than otherwise it would be the case. And these numbers are more consistent, I think, with what Jean would have expected. This is the level of GDP relative to what it would have been. So the growth rate in the Hartman-Smets rule drops by 0.7, but then the economy growth rate tends to stabilize, but the level of GDP is lower. So the conclusion then is that central banks should be expecting more complex shocks and larger shocks. Climate policy design, you want to pick something that will help with central banking, and that's why a hybrid or a carbon tax will help central banks. The outcome for inflation will depend very much on not only the role of the central bank, but also the reactions of the fiscal authority. And if you really were serious, you'd probably redesign the monetary framework to move away from inflation targeting and move towards nominal income targeting. But this is very preliminary, and a lot more work needs to be done. There's a lot more information at my website. And I'll stop there. Thank you.
Thank you, Warwick. We'll now have a discussion of these two contributions by Elga Bartsch. Elga is a BlackRock managing director and heads up economic and markets research at the BlackRock Investment Institute. She has more than 20 years of macro research experience and is a member of the ECB Shadow Council. Prior to joining BlackRock, she was global co-head of economics and chief European economist at Morgan Stanley in London. Thank you, Elga, for joining us.
Thank you for having me. Thank you for sort of inviting me to discuss these two excellent papers and contribute to the discussion on the macroeconomic consequences of climate change and their policy implications. Obviously, in the short time that we have here today, it's difficult to do justice to these two very comprehensive papers. So what I thought I'd do is to highlight 5 aspects that I think are crucial to the discussion. So I will argue that in the climate transition to net zero, that this transition is going to take place against a backdrop in which the world is already shaped by supply shifts and where supply constraints are becoming an increasingly important driver of inflation. The transition itself, the climate transition, will in turn add to and extend those supply constraints and thus add to inflation pressures. This is really a new era in which macroeconomic phenomena are going to be driven by supply, and that will likely bring also more macro volatility. And it will likely force central banks to deliberately live with somewhat higher inflation. And this does mark an important departure from past patterns and will have profound consequences for the economic landscape and the investment landscape. So this is the big important shift is really coming from the fact that monetary policy will be limited in its ability to reduce supply-driven inflation unless central banks are actually prepared to outright destruct demand and allow unemployment to rise across the economy. So point number 1, a world shaped by supply. The key aspect of the new era is that there are not only supply constraints at the aggregate, the macro level, but also very sizable shifts between sectors. And we have seen the impact of such sectoral shifts already during the pandemic, when consumer spending massively shifted towards goods and away from services. That shift created severe bottlenecks in some places and spare capacity in other places. And as prices tend to rise faster in response to bottlenecks than they fall in response to spare capacity opening up, sectoral shifts can push overall inflation higher, even when aggregate activity has not fully recovered. The transition to net zero will thus likely materially reinforce the role of such sectoral shifts in coming years, if not decades, as demand is deliberately being shifted towards lower carbon activities. These sectoral shifts are crucial because if overall inflation is a result of such sectoral reallocations, accommodating that higher inflation in monetary policy decisions will yield better economic outcomes. It does so by facilitating a swifter reallocation of resources towards the new economic structure. And if central banks instead insisted on pushing inflation back to target, then this would lead to an overly tight monetary policy. It would not only actively destroy demand, but also make the transition more costly, both in terms of job losses and also in terms of adjusting the physical capital stock to the new structure. Point number 2, a new inflation regime. The activity restart provided a glimpse of what is to come. So even though the post-pandemic restart will eventually complete, it is not going to be the end of the era of supply constraints. In fact, the transition to net zero will likely be like that post-pandemic activity restart, but drawn out over decades. And it will likely bring new supply constraints and will push up inflation through both broad-based, but also through sector channels. And the reallocation of resources between sectors will likely cause additional supply constraints. You know, for instance, that the IMF estimates that over 2% of the global workforce will need to find a job in a different sector. That's a massive reallocation between sectors. And as demand is likely to shift faster than the resources, the resulting mismatch can push inflation higher. So as a result, the transition is fundamentally about including the costs of climate change in economic decisions, and such costs can be reflected in different ways. It could be carbon taxes, emission permits, government regulations, or shifts in consumer preferences. Independent of how the costs are reflected, we will likely see a broad-based impact on the inflation due to the increase in energy costs. Estimates vary widely depending on the assumptions made with respect to the carbon costs, on the time frame. But make no mistake that not internalizing the costs of climate change will also be inflationary, as research shows that not addressing climate change in the long run will be hitting economies much harder. So the supply-driven inflation presents central banks with a fundamental dilemma. And that dilemma is currently playing out, not just with the post-pandemic restart, but also with the Russian invasion of Ukraine. Monetary policy can simply no longer stabilize inflation and activity at the same time. And that's an important departure of the challenges that central banks faced in the past, i.e. dealing with overheating or undercooling economies on the demand side. And instead, central banks will now have to make tough choices between inflation and growth. And in order to limit the volatility of growth and activity, central banks will likely decide to accept somewhat higher inflation, provided, of course, that inflation expectations are not becoming de-anchored. If inflation expectations indeed are becoming de-anchored, and we're having a discussion about this right now, and higher inflation became entrenched, then central banks would be compelled to act forcefully. And so this is indeed something that we have seen more recently, and it could mean that then central banks are being forced to step on the brakes as far as their policy is concerned, and move interest rates beyond the neutral level and push policy into restrictive territory. Point number 3, rethinking central bank frameworks. Given the likely persistence of those supply constraints in the future, further adjustments to central bank inflation targeting frameworks might be necessary, despite the Federal Reserve and the ECB just having overhauled their strategies. For starters, pursuing price stability as the only goal of monetary policy might imply greater output volatility if the world is shaped by supply. And the ability to look for the best trade-off would be severely limited if inflation is the only objective. Note that greater macro volatility would likely also mean greater financial stability risks. In addition, an empirical evaluation of existing inflation targets could be warranted to actually assess whether they provide sufficient space for all the necessary adjustments that need to happen in relative prices that in order to get to full decarbonization. And then finally, as was already mentioned, a strict application of average inflation targeting or even price level targeting might not be suitable, because it would impose excessively tight policy well into the future in the wake of a supply-driven inflation overshoot. So a flexible interpretation with the ability to look through some of the inflation overshoot would seem more suitable. Point number 4, market and financial stability implications. In the light of the new inflation regime and with central banks potentially forced to act with might, investors are increasingly questioning the perceived safety of holding longer-term government bonds at what are still historically low yield levels. Faced with higher inflation and also higher interest rate volatility, the term premium is likely to widen and eventually could even move into positive territory again. And from a financial stability point of view, government bonds are likely to struggle to provide an effective balance in multi-asset portfolios during risk-off episodes, given how close yields are to the effective lower bound. And in addition, the lower coupons paid cause government bonds also to become more risky in and of themselves. For instance, take the example of a 30-year zero coupon German Bund, which would now roughly have the same volatility as a developed market equity index. So this is quite material, and the consequences are that government bonds are no longer providing an effective offset during risk-off episodes. And also we've seen some short-lived liquidity squeezes that have occurred during such episodes more recently, is something that investors and regulators should consider. Point number 5, my final point. There is going to be a more divergent transition to net zero. The climate transition to net zero was never likely to be smooth and linear, but the new drive for energy security will likely reinforce the climate transition in Europe, while also making it more divergent globally due to the greater need of supply of US and other non-Russian fossil fuels. So as the West is seeking to wean itself off Russian supply of oil and gas, we are seeing a fresh supply shock hitting the global economy in a world that was already hit by supply shifts in the wake of COVID-19. And in the near term, this does make inflation more persistent and causes growth to slow, in particular in Europe, which is experiencing a massive terms of trade shock. The scale, similar to climate change, depends on the speed at which the Russian energy imports are reduced. For the US, the impact is likely to be a lot less pronounced than for Europe, which is a large net importer of energy, whereas deflation is a much more serious risk given the reliance on Russian gas. To sum up, we're entering a new era driven by supply, which is likely to bring higher inflation and more macro volatility. That new regime challenges current central bank policy frameworks and also questions the status of government bonds as safe assets. And these trends are likely to be reinforced by the future transition to net zero. Let me stop here and hand it back to you, Glenn.
Thank you. Thank you, Elga. That was great. I wanted to give the authors a few minutes to respond to Elga's points, if necessary. Jean, why don't you start?
Yes, very good. I think there's a lot of common ground in what we have said. Sorry, I muted myself. Okay. There's a lot of agreement on a number of issues. Let me pick up 3. First, something I did not emphasize, but obviously I agree on. We have to link what we're saying here on climate with the context of energy security. That's not going to go away. Europe is evidently embarking on an accelerated transition away from reliance on Russian gas and, mostly Russian gas, but also oil. So it's going to, in the short term, have the consequence of disturbing the transition, but in the sort of the medium term, it's going to accelerate it. And so Elga was absolutely right to emphasize that another reason to say that we are in a context of supply shocks with all the consequences for macro policy. The second point I'd like to emphasize is on reacting to what Warwick said. We at some point said the opposite. I mean, I said we need to sort of have simple tractable models, and you said we need to have very detailed models. I think it's an apparent contradiction, but basically what I'm saying, I completely, I mean, I understand what you're concerned, that you're speaking of something you want to represent, and if you're not able to represent it, you're not going to be able to sort of discussing and assess it properly. The thing is that you always have sort of to refer to a model that's simple enough to be, something you can read and understand, and avoid the complexities that essentially loses the broad view of what's going on. So I think there's a lot of back and forth to be done between rich, large-scale models and simplified one. There's one thing on which I strongly agree, which I did not emphasize, which is a global dimension. I think this closed economy approach to this issue is not what, is not adequate. Clearly, anything that approaches this issue within the framework of a single economy is going to miss part of the interaction, and so the difficulty is to sort of have a framework that has the complexity also within international dimension sufficiently represented, and avoids again to lose the trackability in the complexity. The final point is about the issue of credibility. I think that was very much behind what you both said. There's a major issue of credibility. Climate policy is essentially not a credible policy at this stage. Governments are putting forward prices of carbon, and we have all reasons to doubt that they're going to meet their target in terms of the price of carbon. Which means that we have to factor in the fact that the agents are not going necessarily to believe what governments are telling them. So I think the mix of, as you were suggesting, work of adaptative expectations and rational expectations probably is the way to go to model. And I think, Glenn, that some of your colleagues at the San Francisco Fed have worked on the consequences of limited credibility in climate policies, showing that it essentially increases the cost of the transition because it leads to a situation where you don't invest in green, you don't invest in brown. So there's a risk of significant underinvestment, with the consequence that it essentially aggravates the supply problems you may be facing.
Thank you, Jean. Warwick, did you have some brief? We've got 15 minutes left, and I wanted to get to a few Q&A, but feel free to respond.
Yeah, very quickly, Jean, I agree completely. You need a mix of models. So you do the analysis in my sort of framework, and you explain it in your framework. But you need to know the magnitudes, and you need to understand where the key sensitivities are. One thing that pops out in all this work is what happens to durable goods. A lot of people think all the actions in the energy sector, but actually because of the investment switches between fossil fuel and non-fossil fuel, which is capital intensive of one type to less capital intensive or more capital intensive, depending on the technology, the durable goods sector gets impacted. And particularly Germany's export sector, for example, which Germany exports a lot of capital goods. And so these second round effects are actually significant, and they're important to understand them. So detail can be useful to understand these bits you might miss. Just on Elga's point, you don't actually have to have more inflation. What's critical in our analysis is the credibility of the central bank's policy framework. So when an inflation shock hits, if the central bank does have a credible framework where you know that they're going to take the inflation out eventually, the expectations will prevent a wage spiral from occurring. But if the central bank has an inflation target but doesn't hit it because of the political constraints with raising interest rates while output's falling, then eventually the inflation will take off. And so what's critical here, and that's why I think nominal GDP growth targeting is a good framework, is that it lets you trade off. If you've got a 6% nominal growth target, which is made up of 3% real growth and 3% inflation target, if you hit your target at 6, but the inflation is 4% because output growth is 2% because of a climate shock, your inflation framework is still credible because you've ex ante told the market where you would adjust when the shock comes, and you didn't need to observe the shock. So I think switching from inflation targeting will enhance the credibility of central banks. You switch to a nominal growth target, and therefore you're less likely to get these inflation spirals coming through the labour market. So I think the policy reaction function is really critical to whether or not we're going to see persistently higher inflation. And I'll stop there.
Thank you, Warwick. We'd like to open up then to Q&A from the audience and the panelists as well. I think they can raise their hand even if they want to ask a question and unmute themselves. I think one place to reinforce, Elga touched on this already, but I'm sure one issue in the minds of many people are the recent supply disturbances, energy-related supply disturbances, natural gas and oil prices reflecting the war in Ukraine. Any initial thoughts on how those events may change the macroeconomic policy response to climate change, or the climate policy response as well?
Glenn, if I can just jump in, I mean, I think Russia's invasion is one of the most impactful climate policies we've seen in the last decade. It's led to a reassessment of what needs to be done. In the short term, emissions will probably go up because we're getting substitution into coal and oil, but we've now realized that we have to get rid of gas reliance in Europe. We have to decarbonize generally because it's not just Russia, it's also the Middle East. It's the reliance on small parts of the world that have vast resources of fossil fuels. In a clean energy world, it's a totally different geopolitical environment. So I think this is actually good for the environment in the medium to long term. It's very bad for the economy and for the people of Ukraine in the short term.
Viral, you've got a question. Why don't you unmute yourself?
Thanks, Glenn. This is Viral, John and Warwick and Elga. My question is really for John, but feel free to chime in, Warwick and Elga as well, which is in the estimates that we saw on the electricity needs in the climate change scenario, I wanted to understand if those are relative to the counterfactual of a climate risk scenario, which is that in many of the RCP scenarios, energy consumption needs go up quite a lot. So for example, because there's going to be very high temperatures, extraordinary air conditioning needs, etc., required, and those energy damages are quite high as well. So I wanted to know if these are relative to the counterfactual or they are just the additional needs in the climate change scenario. So I guess put another way, will the electricity needs be very high also in scenarios of extreme heat?
To my knowledge, but I would have to check, but I'm quite sure of what I'm saying, they don't take into account the change in the physical environment. So that's all the consequence of decarbonization.
If I can just add, in the work we've done and the work the NGFS do, you do take into account the different RCP, the different effects of the policies today on the future climate and the temperature profiles and how that feeds back into the economy. So you do take into account the physical risk. The NGF, because I'm involved with the NGFS process at the moment, they're testing my framework with the integrated assessment models because they're so very different. And so in what's missing from the NGFS work is the extreme events, which we've done some work on, but very, very preliminary. So what we're looking at in the standard baseline climate is the changes in productivity coming from trend changes in temperature. But what we need to model are the hurricanes, cyclones, floods, fires, etc. And we've started working on that. So the physical risk is important, and the transition risk is important in these calculations. Well, I don't know about what John was quoting from.
Yeah, if I may, I think it's better to treat physical risk and transition risk separately, and then in some sort of scenario exposed. But I mean, analytically, they have to be treated separately.
Great. We've had two questions I can combine in the Q&A. One, both have to do with technology. Sort of, where's nuclear going? If that's going to be have we shifted in terms of short run or longer run prospects, and also then the role of carbon capture and carbon capture and storage for fossil fuels, but also direct air capture. I don't know if there are any thoughts on the evolution of technology and how it may have changed.
I can touch on that if that's okay, but I don't want to dominate. So on the nuclear side, the costs of nuclear have been constant or rising, and the risk associated with nuclear has got a premium on it. And so I doubt you'll see any nuclear penetration in excess of what was already on the drawing board in parts of Asia. That's because the alternatives which are now available of renewable energy plus battery technology, pumped hydro technology, ways of actually stabilizing the grid, means that the nuclear, even if you build it, is probably mostly not going to be used, except it's not a peak loading technology. So I used to be a big supporter of nuclear energy, having done the review for the Australian government many years ago, but now I think the technology's moved on, so not nuclear. In terms of carbon capture and storage, there's an important role for that. Different in different countries, different in different production processes. The work that the NGFS, particularly the integrated assessment models, this is their strength. And there's various scenarios where carbon capture and storage are absolutely essential versus other scenarios where it plays a role, but nowhere near as important as other technologies. So that's why you do scenarios, and that's why there are so many different views of the future between now and 2100, let alone between now and 2050.
Two points in complement. First, on nuclear, I would say from an economic standpoint, from a sort of macro standpoint, they're not that different from renewables. Essentially, it's capital. I mean, the fuel itself doesn't really matter in terms of the overall cost. So it's basically, the same nature as renewable. Second, on capture, carbon and storage, I mean, something that's, we should always keep in mind is that in all those 2050 scenario, a large part, some 40% of the emission cuts come from technologies that are not yet at the level of development on which we can safely assess what are the corresponding costs. So that there's still, which is in a way normal, at this kind of 30 years horizon. But there's still quite a lot of uncertainty, of technological uncertainty.
Thanks. Rob, you have a question.
Yes, one of the things that I thought was intriguing was Warwick's suggestion of a hybrid carbon pricing model, where you would have a carbon price that on emissions, and in addition, sort of a longer term cap and trade system. I wasn't clear how that would actually work. Would you have just like a target cap and trade? So you would accumulate emissions, buy and sell emissions to get to net zero, or is there? And are we talking about pricing carbon twice? How does this net price relate to the social cost of carbon and things like that?
Yeah, Rob, good question. So this has been around for a long time, and it's appearing in various governments, and then it gets dumped because of the politics of of revenue capture. The way it would work is you'd say, first of all, what's our profile from a national point of view of emissions between now and 2050? So you have an arbitrary line and you actually cut it below what you think is feasible. So that's a commitment by the government to emit a certain amount each year. You would then bundle them into a government bond and you would allocate that to, in my view, to exposed industries as well as consumers as compensation. So it's like this government bond is the commitment. Then you have a central bank of carbon and their job is to announce in the next year what the price of carbon will be this year. Now the market's trading this year, they're trading futures markets. So you've got a price, you've got a yield curve going all the way out, but the spot price is set by the central bank. So if it's very expensive to cut emissions this year, the central bank window will be open and you can buy as many permits as you want for that year to satisfy your requirement to meet a target. So what that means is you have flexibility along that deep cuts profile to smooth costs year by year. And at the margin, the additional permits that are sold by the central bank is a carbon tax, but the permits that are actually within the system it's also a carbon tax, but the revenue goes to the owners of the permits. So in other words, you're splitting the revenue between the central bank and the allocated permits. So you can trade the entire bond, you can trade a coupon like you can with government debt. So think of it as monetary policy in the short term, fixed price of money, fiscal policy in the long term. There's a credible commitment to fiscal sustainability. Now, the beauty of that is if you do it country by country and every country agrees on what the spot price will be, you don't have to trade permits across countries because the carbon price is the same in both countries. That changes the political dynamics completely from I win, you lose if I negotiate a different target to an allocation process within your country. And you've got efficiency in the short term because all prices are equal in all countries. And over time, you'll get the carbon abatement because you'll internalize those expected future prices and avoid a lot of costs, which means that you upfront the investment and you'll get the revenue coming into the system because of the permits themselves are sitting on the balance sheets of those who will be innovative rather than ripping it out of the energy companies and sticking it into some other part of the economy. There's a lot of advantages and it's discussed at length in a number of papers which are available widely on the internet.
Great, thanks, Warwick. Perhaps just one last question. This issue of macroeconomics, I think, dealing with heterogeneity. I mean, several of you talked about heterogeneity. Climate change is a global phenomenon, but as a supply shock, it has unusually, I think, granular effects by locality, by industry, even by enterprise, and of course, income. Macro typically doesn't engage a lot on distributional concerns. Of course, there may be different MPCs and capital stocks. And any thoughts on how to integrate this difference in both this distribution of local hazards from climate, but also this distribution of local resilience, adaptability, and sensitivity to climate?
I think sort of local impact is more difficult to integrate, but I think the sectoral impact is crucial because I do think that when you have the sectoral shifts, and to some extent this might also apply to sort of regional aspects as well. But if there is, it's really sort of a question of reallocation. It makes sense for a central bank to look through the inflation pressures that are generated by these sort of microeconomic or structural shifts. So when I was talking about central banks living with inflation, I wasn't really talking about an inflation spiral, but really due to the heterogeneity, tolerating some of the inflation overshoot that is created by the asymmetry of prices rising faster where there is tightness and not falling as quickly where there is spare capacity opening up. I would have sort of venture the guess that that also can be shown in models to apply for some of the regional phenomena or local phenomena that you just mentioned, Glenn.
But basically, Elga, you were referring to this sort of analysis that was done post-COVID on the need, to accommodate this relocation. I mean, the Jackson Hole paper of Veronica Guerreri, etc.
Right.
And basically, you're saying that that's the same type of approach we should be using.
Yeah, if you have local effects, I think, within an economy, and you have a similar shift, let's say, in terms of a regional reallocation. Let's assume people want to move away from the coasts and to more moderate parts of the country. I think the similar logic should apply there as well.
Great, thank you. I think we've come to the end of our time here. We have a short break. Looks like an 8-minute break. Is that right, Rob?
I think so, yes.
Yeah, let me thank again John and Warwick and Elga for a great session and their presentations.